Hey everyone, welcome back for another deep dive. This time we're going to be uncovering a really interesting corner of the market, alternative credit.
It's definitely not your grandma's bonds, that's for sure.
Definitely not. If you're listening to this, you're probably already ahead of the curve
Absolutely.
because you're thinking about ways to juice your returns, especially with interest rates being what they are these days.
Yeah, and it's interesting, right? Because you talk about alternative credit, and it's been getting a ton of buzz,
It really has.
especially for good reason.
From,
Yeah,
big institutional investors. And the reason for that is actually kind of a direct line back to 2008.
it all goes back to '08, doesn't it?
It really does. So you had the financial crisis, and that obviously made banks a lot more hesitant to lend money.
Oh, for sure. They got stricter lending standards, new regulations. They just weren't as active in certain areas.
They had to pump the brakes.
Exactly. And you know what happens when there's a void, right? Someone steps in to fill it.
Opportunity.
Exactly. And that's where we see institutional investors really starting to pay attention to alternative credit. And that's what's got everyone talking.
So the big players are taking notice, should you be too? That's what we're diving into today, using a really insightful CFA Institute report to guide us.
It's a great report. Covers a lot of ground.
It does. And we want to really dig into the stuff that's going to be most useful for you, the individual investor. But before we get ahead of ourselves, let's define what we're talking about here.
A good idea. Gets thrown around a lot, that term, alternative credit.
It does, and it's almost easier to define it by what it's not. Think about your typical bond market. Government bonds, highly rated corporate bonds, all traded on public exchanges. That's your traditional fixed income. Alternative credit, everything else.
I like that. Outside the box.
Exactly. It's about private deals, often with the potential for higher returns because you're taking on a different kind of risk.
Yeah, and that's what those institutions were after, right? Higher returns.
Yeah.
Remember, after '08, it wasn't just that banks were lending less, it's that regulations changed how much risk they could take on.
Ah, so it's all about risk appetite.
Precisely. Alternative credit swooped in to fill that void, and it's been growing like crazy ever since. But we'll get into the specifics of why that matters to you, the individual investor, in a bit.
So direct lending,
Yeah.
it's one of those terms that sounds kind of self-explanatory, like you're lending directly. Right. But like a lot of things in finance, I feel like there's got to be more to it
Oh, there is.
than meets the eye.
Yeah, for sure. So we're really talking about these investment funds
Okay.
that are essentially acting like banks, right?
Okay.
They're lending money directly to companies. But the key here is who they're lending to,
Okay.
because they're often willing to lend to companies that traditional banks might shy away from.
Oh, interesting.
You know, maybe their credit isn't pristine.
Yeah.
Maybe they're in a riskier industry.
Right.
And remember that post-2008 world we talked about?
Yep.
This is where it gets interesting, because that pullback by banks
Yeah.
created this opening for direct lenders to step in.
It's like they swooped right in, saw a need.
Exactly. And it's not just like random companies doing this. Private equity firms are huge players in this space.
They love this stuff, don't they?
Oh, they do. They use direct lending to finance their acquisitions.
Right.
And that's been a major driver of growth in this market. Just to give you a sense of the scale here, in 2023, direct lending made up 44%
Wow.
of the entire private credit market, which is worth about $1.3 trillion.
That's massive. So this isn't just some tiny corner of the march.
It's huge. It's a force to be reckoned with. And it's not just about size either. What's fascinating is how this market breaks down.
Oh.
Because you've got funds out there specializing in everything from like small businesses all the way up to giant corporations.
Oh, wow. So there's something for everyone.
There really is.
So it's kind of like, instead of just betting on the S&P 500. Right.
So you can pick and choose your spot.
Exactly. You can get really targeted, you know. You can focus on industries that you think are ripe for growth, regions, all sorts of things.
That's kind of cool.
It is. And it gives you, as an investor, this granularity that you just don't get with traditional bonds.
All right, so we've tackled direct lending.
Yeah.
But let's talk about something a little closer to home, literally. Real estate.
Okay.
I mean, everyone understands real estate, right?
Right. It's something we all interact with every day.
Exactly. So when we talk about real estate loans in this world of alternative credit, what are we really talking about?
So it's a whole different ballgame. Just to give you a sense of the scale, $4.4 trillion
Whoa.
of outstanding commercial real estate debt in the U.S. alone.
4.4 trillion. That's hard to even fathom. It's massive. And it's really important to understand that this market has been shaped by its history. We're talking about, the savings and loan crisis back in the 80s.
Right.
And of course, 2008 had a huge impact as well.
It always comes back to '08.
Right. These events led to tighter regulations,
Of course.
which, as you might guess, opened the door for alternative credit to step in.
More gaps, more innovation. It's like clockwork.
Exactly. But this is where it gets a little bit more nuanced,
Okay.
because the report starts talking about these different categories of real estate loans. Core plus, value add.
Yeah, and those sound kind of like levels of risk to me.
They are.
But I feel like we need to break those down
Oh, absolutely.
a little bit.
So think of core properties as like the most vanilla, lowest risk.
Okay.
These are your Class A office buildings.
Got it.
Long-term leases, very predictable cash flows.
So if I'm a pension fund, this is where I'm playing.
Exactly.
Okay.
Lower risk, lower potential return. Now, core plus, this is where things get a little spicier.
Okay.
Think properties with maybe a little bit of upside potential.
Okay.
Maybe they need some minor renovations,
Got it.
or there's an opportunity to bump up the rents a bit.
Okay. So a little more hands-on.
A little more hands-on,
Still pretty safe, but maybe...
a little more risk, a little more reward.
Okay, I like it. All right, so then value add. This is where we're talking about, like, fixer-uppers.
Fixer-uppers,
Mm.
big time. Think major renovations, maybe even changing the entire use of the property.
Oh, wow. So riskiest category.
Riskiest.
Highest potential reward.
You got it. That's the spectrum.
Okay, so we've covered direct lending. We've talked about real estate loans, two pretty different animals. But, like, what's the common thread here? Like, what's the big so what for someone listening to this right now being like, should I even care about alternative credit?
Well, at the end of the day, it really boils down to this.
Hmm.
Are you looking for ways to earn higher returns than what traditional bonds are offering right now,
Mm-hmm.
especially with interest rates being what they are?
Yeah, makes sense.
And are you open to exploring investments that aren't, completely tied to the stock market's every move?
Because diversification is good, right? Don't put all your eggs in one basket and all that. But then you usually sacrifice some return, don't you?
Exactly. And that's what's so compelling about alternative credit.
Yeah.
It's not about swapping out your entire portfolio. It's more about, adding some spice, a little extra something to potentially boost your returns.
Oh, I like that. Add a little spice.
Exactly. Without, being fully exposed to the ups and downs of the stock market.
Okay, this is all sounding pretty good, but I know there's two sides to every coin. What about the risks? What do people really need to be aware of before jumping headfirst into alternative credit?
You're absolutely right to be thinking about risk, because it's not a magic bullet, that's for sure. It's certainly not a get-rich-quick scheme. And one thing the CFA report really hammers home is the importance of due diligence.
Okay, so you can't just pick a fund and hope for the best.
Nope, not at all. You've really got to look under the hood, especially when it comes to the managers of these alternative credit funds. What's their track record? What's their strategy? Does it align with your goals?
It's about finding the right fit.
It really is.
Yeah.
And another thing to keep in mind is the fee structure, because alternative credit can come with higher fees than you might be used to with traditional investments. So you have to decide, are those fees justified by the potential returns?
Right, got to make sure it's worth it.
Exactly. And then lastly, you got to be realistic about your own liquidity needs, because these investments, they're often less liquid than your typical stocks and bonds. So if you need to access your money quickly, it might not be the best fit.
Yeah, it's always a trade-off, isn't it? Higher potential return, but maybe less liquidity. It's
Yeah.
about finding that balance. But this report isn't just about looking back, it's also about looking ahead. So what does the future hold for alternative credit? What's the crystal ball saying?
Well, technology is definitely changing the game. We're seeing more and more digital lending platforms pop up, and that's making it easier for individual investors to access these types of investments. So that's exciting.
So it's becoming more accessible, more democratized.
Exactly. And then, of course, there's regulation. As long as regulators keep a close eye on traditional banks, that could create even more opportunities for alternative credit to step in and fill those gaps in the market.
Interesting. It's like a constant evolution.
Absolutely.
Mm.
And of course, we can't forget about investor demand, which is only increasing.
Mm-hmm.
And that's driving all sorts of innovation in terms of the types of products that are being offered.
So it's a really dynamic space. It sounds like there's a lot of potential there, but like with any investment, you got to do your research. And the CFA Institute report is a great place to start. We've just scratched the surface today, but hopefully this has given everyone a good foundation.
Absolutely. And as you dig deeper, you might even discover ways to align your investments with your values, which is pretty cool.
Oh, how so?
Well, the report highlighted the growing role of ESG, environmental, social, and governance factors in alternative credit, which I think is a really fascinating trend.
Oh, wow. So not only could you potentially earn strong returns, but you could be investing in companies that are making a positive impact. Now, that's something to think about. Well, that's all the time we have for today's deep dive. Thanks for joining us as we explored the world of alternative credit.